Welcome to Striker Web TV, the only live internet broadcast of dinar-related Iraqi news. Striker Web TV is sponsored by DinarCorp.com. They have been brokers of the new Iraqi dinar since 2003. Dinar Corp stands for one thing above all else, a commitment to you, the customer. This, coupled with time-honored values like honesty, integrity, and higher standards of service. Their customer dedication has allowed them to earn the trust and respect of the currency community worldwide. The Striker team of dedicated newshounds has searched the major Iraqi news feeds to bring you the latest articles from around the net. Striker is committed to bringing you his commentary on the latest news, rumors, and articles, as well as guest appearances by the movers and shakers within the dinar community. Our motto is, the facts start here. Now, without further introductions, here's Striker.
Hello, folks. Welcome. Appreciate you joining us today. I am Striker, and our guest today is Dave, or better yet, better known on the website as Damagaff. He is one of our Striker blog professional analysts. Welcome, Dave.
Hi, my name's Dave, and I'm a dinarian.
I had you say that one more time, Dave. I had your volume down a little bit low. Take it from the top there, Dave.
I said, hi, my name's Dave, and I'm a dinarian.
You have listened to one too many conference calls, my good friend. I'm sorry, that got my tickle. Oh, that was funny. Yeah, you just been waiting to do that, haven't you?
I have.
Oh, that's a good way to get this program started. Thanks, Dave. I needed that. By the way, I just listened to a conference call the other day. I got one sent to me, and I normally don't have the time to listen, and I did, and it was kind of comical because one of them calls it how do they say dinar? Dinars. They call them dinars. It's all right. Listen, I'm from Texas, man. I've got some kinfolk. See that coming out in me? Kinfolk. You started it. I got some kinfolk down in West Texas that talk like a Texican.
Yeah.
They talk like a Mexican and a Texan. We call them Texicans. I'm sorry, that tickled me, folks. That's funny. That's a good way to get this thing started. Well, what we're doing here, folks, is since we had such a trouble streaming live from our Saturday event a few weeks ago, which was a great event. It really was. I wish everybody could have been there, but we're gearing up for an RVQ, hopefully in the near future, and we can all get together and we can all enjoy each other's company and fellowship, and we can get. I could get my laughter because everybody's going to be cutting jokes. You know that, right? Just like this cut up right here just did to me. That's funny. Well, folks, what we wanted to do is we wanted to refilm this for everybody. We're going to do probably three shows just about this, and here's what we're going to do. We're going to do this as a live stream. I didn't put out a memo or anything else because if we need to stop and redo it, we'll do it. But we're really going to do it. It's going to be Dave and I. Then it's going to be Mike, which is Honest CPA, and myself. We'll do a separate show. And then I'm going to do a third show with all three of us, okay? And that's the way we're going to do it. And if I see a need to edit it, all three of them together, we'll do that. If not, we'll keep them as separate shows. And then we can start doing some Q&A and have some other shows. Dave and I are probably going to try to do a show, what do you think, every week or two or something like that. And just this is a short educational show, don't you think, Dave?
Sounds good, yeah.
Yeah. And there's so much to cover, folks. You know, I try to cover it 5 days a week on my day shows now, afternoon Striker with Striker shows, but you know, there's a lot of stuff because it's so complicated. I'd like to have the professional analyst chime in and listen to their take on things instead of listen to strikers all the time. So without further ado, I want to go ahead and let you start your your program, if you don't mind, or your presentation, and I'm going to switch it right to your presentation screen, and it's all yours, Dave.
Sounds good. Well, I appreciate that, and I appreciate you indulging a little bit of humor. Life's too short to be serious all the time.
Yeah, I'm going to go back to you on that. You're exactly right. That's right. And I appreciate that.
On the screen, of course, we all have our screen names. Mine is Dan McGaff's, basically initials of my name itself. And I want to get in just a little bit, very quickly, my background. I am a former licensed securities professional, and I'll explain why I'm a former licensed securities professional in a second. I started off my career as a Series 7 and 63 security representative. Basically, that's a federal and state level securities representative that's licensed to sell stocks, bonds, mutual funds, even get into some of the puts and calls options so that you can basically take insurance against your investments. Then I became a securities principal so that I could actually manage other securities representatives, and I was also a registered investment advisor. That all changed. I became very disenchanted with the investment world. Towards the end of the 90s, decided to get out of my practice back in Michigan. I had my own financial advisory firm, sold that off to my former business partner. He's still active up there in Michigan, but I moved out here to Arizona. I started my career in 92 with IDS Financial Services and Sigma Financial Advisors quickly after that. For those of you that aren't familiar with those firms, IDS became American Express Financial Advisors and now is Ameriprise. And back in the day was the premier company to get financial planning training. Absolutely head and shoulders above anybody else because they took a comprehensive approach. They didn't just come in as a stock jockey trying to sell a specific product. They actually went through a complete financial plan to find out what the goals were for the client and how to get the client to the goals. But I quickly learned that I really wanted to have a different area of focus expertise. I wanted to make sure that I was reaching the community that I wanted to reach most, and that was small business owners. So I went to Sigma Financial Advisors and got training there so that I could specialize in small business and advanced estate planning. Then throughout all that training, I decided it was time for me to break away. There were too many restrictions. There were too limited a portfolio of products that were available when the whole world of products were available to us. Instead of just selling IDS products or Sigma's products, which was Connecticut General Insurance at the time, I wanted to be able to sell funds like MFS or recommend Janus or any of the world Gabelli funds, any of the big names that were out there at the time. So I opened my own firm and then brought the gentleman that got me into the financial world through IDS, I brought him on as a partner. So anyway, long story short, like I said, I transitioned out of there at the end of the 90s, moved out to Arizona, and in 2001, 2002, let my licenses lapse because it took a while for me to gain this education, but I finally realized that what they call the variable markets is fixed. It really is fixed. The big market makers, the people that manage the pension funds and the mutual funds and the sovereign wealth funds and the hedge funds and all those big money managers are the ones that call the shots, and they can actually make the market move at will. As a matter of fact, a couple weeks ago, Goldman Sachs actually made a trade that they didn't intend to make because everything is done electronically now in fractions of a second. And within about, I'd say it was about 20 seconds worth of trading, they lost $100 million. But what they did was they impacted a move in the market that offset what had been Thursday and Friday, two major losses in the market. So it really is a rigged game. So now I'm totally on the fixed side, and I'm the guy that agents all across the nation come to. And it's not to overstate my position. I work with a national brokerage firm where agents call in to find recommendations for their clients. What's the best product? What are the best rates? What's the best type of insurance? So that's my role every single day. I now am an advisor to those agents on the fixed side, representing what we call double insured products. And I can explain that separately, but that's basically my background on the financial side. As I alluded to in the first training, and I didn't allude to here, but towards the end, is that on top of all that, after I got out of the financial world, and my world basically hit the shredder in 2001, 2002, I became a pastor in 2003 through 2010 and still have a small home church meeting today. So everything that we do, everything that we talk about has relevance not only in the financial world, but other things that I do with regard to looking at world events in light of prophecy. So that was it. Our purpose here today, of course, is not to talk about me. It's to talk about what's going on in the world that we're faced with in our current economy, and how do we prepare for what's going to happen with the Iraqi dinar. That's why Stryker decided to get this forum started with the professionals, and it's why we decided to have this online presentation so that we could talk about what's coming down the road, understanding the opportunity that's in front of us, but also understanding the risks that are presented. We also, as Mike gets involved on a CPA, he's going to talk about the taxation aspects of it. I'm not going to get into any of that because that's his area of expertise, but those are the things that we're going to talk about today. I know that many of you out there understand the history of money and the role of gold in that. But what I wanted to do is just touch on it briefly for those of you that really don't understand that, because at the core, currency really is just a medium of exchange. If you're a guy that's living in the wilderness and you trap wild animals and you kill wild animals, your form of currency, your form of trade may be the wild skins, the actual animal fur. That may be your currency because that's what you use to trade. Currency, again, just a medium of exchange. For over 2,500 years, gold and silver have been a recognized medium of exchange, all the way back through early Bible times. And even today, it may not be the standard that currency is measured against, but gold is looked at as a reserve. It's looked at as a store of value that people can use in emergency times. I want to give just a very, very quick history about the gold standard and the petrodollar. When you look back at the formation of central banks in the early 1900s and their role in how we actually create money today, I'll get into that in a minute, but we used to be on the gold standard. So every dollar that the United States produced was backed by gold in Fort Knox. That was true all the way up until 1971. My birthday, August 15th in 1971, President Nixon, because of a confluence of issues of the day with regard to debt and money supply and the inability to step outside and create enough money to take care of some of the things we needed to, decided it was important for the United States to get off of the gold standard. He didn't consult with anybody else. He just decided unilaterally to do that. Well, that posed a problem for us because if we go off the gold standard and we are the world reserve currency, there's no reason for people to go to the U.S. dollar anymore. They could go independently and trade. So at the same time, Kissinger decided he would make an agreement with Saudi Arabia because Saudi Arabia was vulnerable. They didn't have an army to protect their land, and they had all their oil fields that needed protecting. So we stepped in and we promised protection for the Saudis in exchange for the OPEC nations trading all the oil in U.S. dollars, thus the onset of the petrodollar, the term that you hear today. So where do central banks and fractional reserve banking step in? Because that's the system that we're on today. First, you have to understand how the fractional reserve system works. If you take $100 and you deposit it in the bank, that money doesn't stay in the bank. If you look at the chart as it comes down, you'll see that the bank will keep $10 and lend out $90, and then the bank keeps $90 and lends out $81. As you go down that cycle, as we continue to go down, you'll see just after 7 loan cycles, $100 turns into $569, almost $570. It takes, because of the fractional system, it takes about 115 loan cycles before $100 turns into $1,000. And that all looks good on paper because on one side of the balance sheet, you'll see $1,000. And then after that, you'll see $900 on one side of the balance sheet as far as deposits, and then you'll see $100 in reserves. The real problem is $900 is out there in circulation, but there's not $100 sitting in the bank really in reserves. It's just entries in a computer. The only reserve money that still really exists is the original $10. And that other, outside of the original $100, all the rest of that money is just fabricated. How did they do it? Because our whole system is based on credit. If you remember President Bush's words after 2001, September 11, 2001, when they were looking at the world and the financial crisis that was potentially looming, what was his word? His exact statement was, go out and buy stuff. Go to the stores and buy things. Support the economy. Why? Because he understood that our economy is based on credit. Without credit, money doesn't flow. Without credit, money's not created. And we'll get into that a little bit more in future slides. But the basic gist is everything that we do in our economy today is based on credit. When you look at our world system, the IMF is really the key player. And the IMF, although it's stationed here, is an international concern. Central banks are critical for the independent state nations, but international trade is done through the Bank of International Settlements. And I'm not going to get into Bretton Woods, but Bretton Woods is what established the IMF, and the IMF is what regulates. Once you're away from a peg that the state itself controls, and you're in the free market, and you're in a floating exchange rate regime, the IMF is who really regulates the exchange rates in a manner of speaking, because everything flows through the IMF and the Bank of International Settlements. So, yes, the market drives it, and we're constantly seeing the price of the dollar fluctuate in comparison to other world currencies. But as far as the IMF is concerned, the United States dollar is a fixed, every single day, a fixed rate. Again, I'm not going to get too far into the exchange rate regimes, but just know there's two different versions. There's a pegged version, and that's what Iraq is currently experiencing. It's a pegged version where it's valued against another currency, the U.S. dollar. And unfortunately, as Stryker and I have exchanged emails back and forth, Iraq is susceptible to whatever happens in the United States as a result of that. We need to see that unhinged or unanchored as quickly as possible so that we can eventually get to a floating regime, because the floating regimes, unlike the peg regimes, are market-driven. Sure, again, the exchange rates are influenced by what's going on in the IMF and the Bank of International Settlements, but it's more market-driven, especially once it gets on Forex, because people will buy and sell currencies based on what they expect to happen in the individual sovereign state economies. So a lot of this has to do with what's going on the world stage. So what actually influences exchange rates once you're in the market? There are some organic influences. Some of that is going to be interest rates and inflation inside the nation states. Some are going to be outside economic factors, outside of interest rates, like what's happening with gross domestic product, what's happening with their money supply, like the Fed printing money. Not only our Fed, but the banks of Japan, the banks of China, all throughout the world, the central banks have been printing money. And you'll see that the IMF is actually today very, very worried about that very problem. But also economic factors such as how much debt does that nation state hold. Trade balances play a role. Stryker and I got into this a little bit. I sent him some information about some, what I think is kind of interesting data coming directly from some of these sources I'm looking at, not only from the Bank of International Settlements, but elsewhere. The Arab League was looking at how to value the Iraqi dinar, and it had one value on the balance sheet as far as what the exchange rate was, but it had another value entirely for what they allowed for a factor for their exports. And I don't know what that looks like in 2013, but the 2010 number that I looked at there was a huge disparity. So definitely trade imbalances between exports and imports play a role. Those are organic influences. but there are also artificial influences. You'll see if you ever look up online exchange rate influences, there's something called purchasing power parity, where they'll try and compare the purchasing power of a dollar in one country with the purchasing power of a dollar in another country. And although they're trying to do what some economists like as far as trying to level the playing field to make sure everybody gets a fair shake, it actually in the long run impairs the ability of some certain countries to really prosper the way they should, because it gives them the impression, I'll just say this, it gives them the impression that they have to stay where they are, or they can stay where they are and everything will be equalized. If they didn't have that purchasing power parity, they'd be forced to innovate and grow their economies and do things that are going to get them further ahead so that they can get on the same page with the rest of the world. Instead, with purchasing power parity, you have these countries that they're depressed, they're emerging markets, they may be even microeconomies where they don't have the ability to produce, and they stay in that stagnant state because the world basically offsets their prices through purchasing power parity. It doesn't have to be that way. They could actually step up and innovate and become a world player eventually through market demand and actually the demand of their own people to grow their economy, but they don't through purchasing power parity. So that's enough on that. So why is any of this important? Why do we care? Why do we need to talk about the dollar? Why do we need to talk about gold? Why do we need to talk about exchange rates? Because all of that influences where we are today. We need to understand the factors that are going to influence our investment before and after it RVs. Once it redenominates and revalues, then we're in a different world. We're in a different playing field. We need to know how to prepare for that once it happens, because there's going to be factors of influence. There's factors inside Iraq, but there are also now, once we get to that point, going to be factors outside of Iraq that are going to influence the value of that Iraqi dinar. Some of that, as I've already alluded to, is that what happens to the U.S. dollar. And the other side, and Stryker he's been doing a great job of promoting this. The Northern Trust Partners video from Bloomberg, where they talk about the investment that's coming in from foreign investment through Citibank Group or Citigroup is huge. Not only is it going to be coming in through other companies like the trust partners, but it's going to be coming in through banks and their arrangements. They're already talking about opening up the banking industry so other banks can come in and creating a more level playing field for them to play a role. They need that to happen so that they can have more than just the centralized control that they have right now. Because as it stands, there's too much centralized control with the two major banks in Iraq today. There's the central bank in Rashidi and I forget the name of the other one. Stryker, what's the name of that other one?
Rashid and
yeah,
Rafidi. Anyway, yeah, it's close enough.
Those two are. I mean, between the three of them, they basically hold all the cards. We need those other banks to come in to level that playing field. Inside Iraq, you have the economic agreements that Stryker's been talking about, critical. You also have the security issues inside Iraq that are critical because we have to get that under control in order for people to feel comfortable. Even yesterday, the webcast that Stryker put out, he was talking specifically about the demand. There's an internal demand for people to come in that are technically skilled. People are not going to want to come in if they're fearing for their lives. So we need to get the security issues in place. But I want to touch real quickly on what's going on behind the scenes. Shabibi has a great video. I can't remember who was that posted. I don't remember if it was Time's Up or Diana or Iris. It was one of them that posted that there were 3 videos right in a row that were posted. One of them was Shabibi's, and I thought he really had some good things to say. Some of it was very telling. He was talking about how the deleting the zeros process and monitoring the exchange rate go hand in hand. He was talking about how the decision to make all that happen, the decision was already done and it would be implemented soon. He also talked about how it would take a coordinated effort, not just with the Central Bank of Iraq, but with announcements so that everybody knew what was coming. It's not going to be done behind the scenes, closed doors, only a few people know, and the big whales get fed first. Oh, my goodness. That stuff drives me crazy. No, there's going to be an announcement. Everybody's going to know. And it's going to take time to educate not only the public about what's going to happen, but it's going to take time to educate the financial markets on how this transition is going to help and happen. Then they also need help from the government to get it done. Again, getting all the economic agreements in place, tariffs and all the HCL and everything else that's going on. But what really struck me, he said, they especially need help from the security forces. And it stopped me in my tracks. What? What do you mean? You need help from the security forces? The security forces, he acknowledged, are taking care of other issues in the country of Iraq. But he said specifically, in order for currency reform, the Central Bank of Iraq, needed help from the securities forces. What? What is that all about? So anyway, there's a concerted effort underway to complete the agreements and bring Iraq to the international stage. We've talked about, or Stryker specifically, in some of the blogs that I've posted, we've talked about the World Trade Organization. We've talked about the ISX ascending to the world stage. Currently, what's going on behind the scenes is they're already part of a number of exchanges that are Arab-related. That is under the World Federation of Exchanges. So you have the World Federation of Exchanges, then you have underneath that things like the New York Stock Exchange or NASDAQ or the Chicago Mercantile Exchange, the options exchanges. That's under the World Federation of Exchanges. Underneath that, you also have the Arab League that has its own organized structure for its stock exchanges. What you don't see behind the scenes is Iraq ascending directly to there. Overarching all of that is something that's very similar to the Securities and Exchange Commission, which oversees the New York Stock Exchange. On the international scale, this is what Stryker has been talking about as far as the International Organization of Securities Commissions, the IOSCO. IOSCO is the regulatory organization that oversees all of the exchanges and all of those trading organizations. So you see that Iraq is trying to get on stage there. We also need to see the Iraqi dinar get on Forex, because once it gets on Forex, then again, we have internationally recognized currency, and we have a currency that's tradable internationally, and it will be susceptible to market forces. We won't have to worry about being pegged to a currency. We can get away from the dollar. Because as we understand what the world is saying about the dollar currently is in a very precarious place. It's pretty much on the precipice of some real dynamic change coming. And I don't know how soon that change is coming, but the world is pressing for it, and it has been for some time. So moving on, opportunity and risk. I want to talk real quickly about what do we do after the fact? Because there's different types of places where you can hold your money, leading up to the revaluation and after the revaluation. As you look at this quick little graphic that I put together, it goes from the least risky to the most risky. Cash and cash equivalents, checking accounts, savings accounts, money market accounts, those are going to be cash and cash equivalents. CDs, those are going to have the least amount of risk. I'll get into a little bit more of why that's not really true in a minute, but that's where it's perceived. No risk. You put the money in the bank, it's backed up by the FDIC. Okay. From there, you move to government bonds. And in that mix, you have municipal bonds that are owned by your state and local governments. You have the federal bonds that are owned by the federal government. Then you get a little bit more risky, and you give money to corporations in the hopes that someday they'll be able to repay that debt, because a bond is a loan. They pay you interest on that loan, and then they give you your money back at the end. So you give it to governments first, less risky. Corporations, a little bit more risky. Then, moving even further on the risk scale, are domestic stocks. Domestic stocks is where you actually purchase a small portion of the company. Now you're not loaning money to that company. You're actually an owner of that company. Then from there, get a little bit more risky. You go to international stocks and bonds. And the reason that you have a little bit more risk internationally is not only do you have the volatility of the potential ups and downs of that particular stock, but you also have the problems with the exchange rates. As we've already talked about, exchange rates are very important. So what's even more risky? Currencies and commodities. Commodities are things like grain, pork bellies, anything that you can basically gamble on the value going up and down. And commodities, the reason they're volatile is they're subject to a lot of outside influences. If it rains or doesn't rain, the commodity prices can go up because it affects crops. So we already know what commodities are. Currencies, of course, is what we're involved in. And the reason that they're more volatile is you have a couple of different influences, as we've already indicated, what can affect exchange rates, but you also have what does the country itself do with regard to the supply of their currency as opposed to their reserves, and how is the world going to view that? Since 2008 and the crisis that we've seen there, all the central banks of the world have acted in unison to expand the money supply, and they did it on purpose. They did it to stave off the potential problems that were coming. But now we're faced with a whole new set of problems because we don't just have one central bank and one country to worry about. We have all of the countries to worry about. We have what's going on at the Fed, which is the largest of all of them, but we also have internationally all the other central banks. And what do we do as we start to draw in this money? Because that's ultimately what has to happen. And the IMF, I was talking to Stryker about this yesterday, the IMF is freaking out, to put it mildly. Christine Lagarde, the director of the IMF, has come out on 2 occasions warning the Fed that this unconventional monetary policy that we have right now, quantitative easing, all fancy names for money printing, they have come out very specifically and said you cannot act without taking into consideration how it's going to impact the rest of the world, period. If you do, there are going to be extreme, perilous, unintended consequences. That's the bottom line. And you have to read their coded speak when they're saying it, because they try and hedge everything that they say in a way that's not going to cause panic. But at the end of the day, that's exactly what they're saying. They're saying, we don't understand entirely how this is going to happen. If we wait too long, it's going to cause a problem. But if we do it now, we've never been in this situation. We're in uncharted territory. We don't know how all of this is going to play out at the end of the day. But if we do it too fast, it could be bad. If we do it too slow, it could be bad. No matter what, they're not seeing an easy fix for this. They're not seeing a solution that's going to leave anybody unscathed. What they are warning is if we do it as the United States too quickly, it's going to have impacts not only here, but abroad, and it's going to greatly impact the emerging markets. So that's the bottom line. What I want to talk about now is a false sense of security that we have as people that are putting our money in places like the bank or places like the brokerage house in the stock market. I already told you that the game is rigged. Well, not only is the game rigged, but the people that are pulling the levers intentionally wanted to give you a false sense of security. And I'm going to explain real quickly what that false sense of security is. I'm going to talk very specifically about the Security Investors Protection Corporation, the SIPC. I'm not going to go in depth with the NCUA. That's the basic insurance policy for credit unions. But I am going to get into the FDIC, which is the Federal Deposit Insurance Corporation. That's the one that backs your deposits in the bank. So let's look at SIPC, the Security Investor Protection Corporation. It was created by Congress in 1970, and it was all intended to give a sense of security to investors. That's it. Because when you look at the underlying dynamic of what really is happening with the Security Investor Protection Corporation, it's nothing but smoke and mirrors. Because people put their money in thinking they're protected, but it really only insures insolvent brokerage firms. It doesn't insure the investor themselves directly. The maximum amount of insurance is up to $500,000 per customer for securities, up to $250,000 for cash. And here's how the fund is funded itself. As of the end of 2012, they had $1.4 billion in their fund. and we don't know what the percentage is of the actual dollars that are invested in the market. When I tried to verify these numbers directly with the Security Investor Protection Corporation, I was told, and I was also told by the SEC, we don't know. We don't know how much money is actually out there as far as what's in the stock market, whether it's through the New York Stock Exchange or NASDAQ, the futures. They didn't give me a number. They were unwilling to verify. I can't say that they didn't know. They just were unable or unwilling to verify. Well, if you go to the World Federation of Exchanges and you look at their numbers just for NASDAQ and the New York Stock Exchange, not the Mercantile Exchange in Chicago, not the futures market, just NASDAQ and New York Stock Exchange, you'll see that those numbers were over $18 trillion in 2012. $18 trillion, and all they have in their fund is $1.4 billion. What happens if we have major problems and we have brokerage houses like what happened in 2008 start to go under? Because not all those dollars that you think are in stocks are actually held. Some of the stocks that they hold that you think are in the account are actually rehypothecated and they're out. They're no longer in their portfolio held. So you think you have a stock certificate that's not really there. You have a lot of that happen, and that $1.4 billion is not going to cover all the losses. Again, smoke and mirrors.
Ouch.
So
sorry, I had to say ouch.
Yeah, I mean, it's scary numbers. And it's even worse when you look at what's going on in the banking industry, because if you look at the banking industry and the smoke and mirrors that's there, we're going to get the real numbers. It's sad to think, and here's what people think: I have an axe to grind, and I'll tell you, this is my axe. I got out of the securities industry intentionally because of the fact that the game is rigged, because of the major market players. I'm now in the insurance side of things, because when you give money to an insurance company, they have to, by law, keep that money dollar for dollar. So whatever you have as a liability to that insurance company, if you give them $100,000, I'm not going to get into the specifics of how the contracts work, but they're not going to give you $100,000 right away. That's why they call that. There's a part of the contract called a surrender charge if you wanted your money tomorrow. It has to be there because by law they're required to have dollar for dollar backing. So that surrender charge might be 10%, 7%, 9%, whatever it is for that company to have some operating capital. But that $90,000 is sitting in an account somewhere, and the majority of it's in very, very conservative bonds, so that if you ever need your money, it's there. That doesn't happen in the securities world, and it doesn't happen in the banking world. But yet, when we're comparing our rates to a bank's rates, we have to put a disclosure on all of our advertisement that says this is not insured by the FDIC. Thank God it's not insured by the FDIC, because the FDIC is broke. All right, so back to my line of reasoning here. Let's talk about, just go ahead and scroll through this, because I can give all the information. There's a report I'll mention at the end that goes through all these numbers. But just know this, on their best day, currently, the NCUA, the National Credit Union Administration, that's basically the insurance fund for credit unions, for every $100 that's in a deposit account, only has $1.32 of insurance backing it. Bottom line.
Oh boy! Now that's a little scary, isn't it?
Yeah, and that's when they're fully funded.
When they're fully funded.
That's fully
so
funded.
Between all these organizations, we're in. How would my West Texas relative say? We're drowning without a boat. Something like that.
We're in deep weeds.
Yeah, there you go. Deep weeds. Without a weed eater. Without a weed eater.
Without a weed eater.
Yeah. All right, I'll go back to this. I tell you, this stuff is, you're giving me an education, by the way. Some of this I knew, and some of them I didn't have any idea. By the way, we're answering a few questions of some of our members as we go along through here, which I would point out some of the questions were, how much insurance is really covered, or how long does it take the FDIC to really pay you out and stuff like that. So I just wanted to throw that in real quick. for everybody and tell you that I'm kind of monitoring questions, and these questions are already being answered. So, and folks, I'll let you know this. Dave will finish his educational presentation, and then we'll talk a little bit. And then I'm going to have Mike on. I'm just going to reinsure this. And then Mike and I'll get on, not today. He's busy all the way up until later today, and then I'm busy when he's not busy. But maybe tomorrow, I think Mike and I are going to do our show, which is Sunday, and then we'll try to maybe all three of us on maybe next Saturday, and then you guys and gals can submit some more questions after all this is done, and we'll be glad to answer any more questions. Anyway, back to you, Dave, and I'll pull up this presentation. You want me to go to the next one, correct?
Yeah, go ahead and go to the FDIC, and I'll say this. I remember that one question that came up, and I don't know if you're going to get to it again at the end, but I'll answer it now.
Okay.
The FDIC basically has 99 years in which to repay. Now, they're not going to take that long, but by law, that's how long they have to take.
Right.
People looked at what happened in Cyprus, and they thought, wow, that's tragic. That could never happen here. News happens every time a bank closes.
Yep.
Because the people that aren't insured never get all of their money back. It's always a fraction of whatever they had. So the bottom line is you're going to have a situation, if you have more than $250,000 in that account, that if you have more than $250,000, you'll get your insurance up to the $250,000 because the United States government can print as much money as they want to right now. But above that, you're going to get a haircut. And that money is going to be tied up for a period. You'll get some up front, but they're going to take time to repay. Maybe it's a year, 3 years, 5 years to repay the balance. And it'll never make you whole.
Wow.
So that's the bottom line. So back to what's the situation with the FDIC? Well, the FDIC was created way back before 1970. The FDIC was created in 1933. Did anything happen back then that's of significance? I won't get into that. Anyway, the FDIC currently insures up to $250,000 in deposits. That was raised from the old $100,000 threshold. Now, there was a lot of talk about you can put your money in certain accounts and it'll be protected. And you can put your IQD money, IQD money, your Iraqi Dinar money in that account. It'll be protected from a fall in the dollar. They were taking that from a program that was actually defunct as of the end of 2012. Because in a non-interest-bearing account, you could put money in there, and it was unlimited insurance on a non-interest-bearing account. That program no longer exists for anybody that's still spreading that rumor out there, and I won't name any names, Tony.
I knew you were going to say that.
Yeah, I had to put that in there. Deposit insurance fund.
Dave, real quick,
Yes.
Can I just add something real quick? That this, when can you answer a question for me? And I have the answer. I know the answer, but for the folks out there, when was it raised from 100,000 to 250,000 on deposits FDIC after 2008, right?
Yeah, when it went into legislation is not when it passed. It was supposed to pass in 2009. It didn't actually pass until 2010.
And why did they raise it? Because of what happened in 2008, right?
Yeah, because of what happened in 2008.
Okay, sorry, I didn't mean to interrupt you. I just want to make that clear because every time you had mentioned this 1933 year and what happened prior to that caused all this, well, guess what? Another major financial issue caused that right there to go up, that number right there. So anyway, I just wanted to point that out. And like Dave says, and what we're trying to warn everybody about is be prepared for another financial crisis, to happen ahead of time, and we could save ourselves a lot of grief later on. Anyway, sorry about that. I just needed to chime in.
Absolutely. That's perfect to chime in there.
Okay.
Now, let's talk about the deposit insurance fund that the FDIC has. Now, this part is going to probably freak a little, maybe a large population of the people that are going to watch this. It's going to scare them just a little bit, and here's why. The mindset is that you put your money in the bank and it's protected. It's insured by the full faith and credit of the United States government. We're going to get into that in a little bit too. But the reality is, as it stands right now, at the end of 2012, there were $9.47 trillion on deposit in the banks that are tied to the Federal Reserve. Okay? In the Federal Reserve System, $9.47 trillion on deposit. Now, of those $9.47 trillion, $7.4 trillion were insured. $7.4 trillion with a T, trillion dollars insured. In their insurance fund, however, not so much. Their target funding, that's what they want to have in the bank to insure your deposits, is 1.25%. So, for every $100 that would be in deposit, they want to have $1.25 to insure your funds. The problem is they haven't met that goal since 2005. Their current funding is at 0.45%. So for that $7.4 trillion, they only have $33 billion in this insurance fund. Think about that for just a minute.
Ouch. Sorry, I just stumped my toe. Again.
That's a big ouch. Only $33 billion to insure $7.4 trillion. And I, as an insurance professional, where the insurance company has to back by law, dollar for dollar, have to put disclosures on that it's not FDIC insured, when they only have $33 billion backing $7.4 trillion. Are you kidding me? It makes me go out of my mind.
Wow.
When I see that kind of stuff.
Can I ask you?
But it gets worse.
Wait. Before you go on, let me ask you a question. So, just to clarify, insurance companies have to back theirs by every dollar for dollar. So if our government went under practiced what they preached, we'd be in good shape, wouldn't we?
Yeah, we'd be in great shape.
But we don't, because they don't. It's like the old parrot saying, "You do what as I say, and not as I do."
Yeah, they spend like drunken sailors. And even now, what we're facing right now, it's been under the radar for the longest because nobody wanted to talk about it. But, and I'm not going to get too political here, but the sequestration that happened earlier this year that basically forced government spending to be reduced has saved us. And you'll see that the deficit this year is less than the deficit from last year. And it's because of that forced spending. Why did we have to do that? It was because agreements that were made several years ago in order to get other legislation pushed through, including the raising of the debt ceiling. We didn't need to. We shouldn't have ever raised the debt ceiling again. We needed to control spending. But they said, but if you just raise it now, we'll cut our spending in the future. But we didn't cut our spending.
No.
So these forced spending cuts went into place. And now, we're right back to where we started, having to have the debate about should we raise the debt ceiling again. Are you kidding? When we get to a slide and a couple slides down the road, you'll see how perilous our situation already is. We want to add more debt on top of it. It doesn't make any sense. We need to have somebody that has common sense running our government like a corporation that needs to produce a profit in order to keep its balance and its books in order. We haven't run it that way in a long time.
We need a businessman. We need a real businessman in that office next time, folks. Remember that. Yes. When you go to the polls next time, look at who's running. Forget your party lines. Go across those party lines. I don't care. His qualifications need to be business. Sorry about that. I'll stop chiming in, but I had to do that.
Stop. It'd be nice if we could actually verify some of the credentials he has too. I mean, that's
right.
I mean,
Don't get me to laughing again. You'll get me chuckling. All right.
Anyway, so back to the FDIC. It gets worse because what I want to look now at is vault cash. Actual tangible bills that the banks keep on hand. As of the end of 2012, with the $9.47 trillion that was on deposit, they only had $65 billion of tangible cash in a vault somewhere. Now, I alluded to this in the first presentation that we did that didn't go public, but think about any movie that you've watched where there's a kidnap scenario and the person is demanding money, $1 million, $10 million, don't matter what that number is. Person always says, I can get the money, but it's going to take me some time. And the reason for that is the bank has to actually call their repository and say, we need X amount of dollars in cash to our vault tomorrow. And then that money is actually delivered to them. It's the same system. If you read Billions Over Baghdad and that whole scenario where they loaded up the semis and they put it on the plane and they shipped it over to Iraq, it's the same exact thing with our banks on a daily basis. They have to request the funds that they're going to need. So the money isn't actually sitting there in a vault somewhere. It's all entries in a computer. So imagine if there's a bank run tomorrow. Anybody that's seen A Wonderful Life can understand exactly how perilous that situation could be. It could wreck our whole system, and there's no money. Let me repeat that. There's no money to back it. There isn't $7.4 trillion, let alone $9.47 trillion sitting anywhere. As a matter of fact, the fractional reserves that the Fed claims to have on their books with electronic entries is only $1.5 trillion. So they have these entries in a computer somewhere, but $1.57 trillion is still only a small portion of that $9.47 trillion that's out there. What happens if we have calamity and everybody wants their money tomorrow? Think about that. Oh, that's right. It's all backed by the full faith and credit of the United States government. Is it really now? Because last time I checked, the U.S. government isn't in great shape. But let's look at the next graphic where it gives a visual of what's happened with the FDIC since 2005. Like I said, it's not been since 2005 since they were at their target of 1.25% funding. You can see that they did okay up until 2007. That green area, the reason I have it in light green, is they considered a safe operating range to be at 1.15%. Anything above 1.5%, that's their comfort zone. Well, mid-2008, we saw those numbers start to go below their comfort zone. And what is that there in the middle? What do those red lines indicate? Oh, that's right. That's when the FDIC actually owed every depositor money for the money that was on deposit. They were actually in the red. They were bankrupt. They were broke. And they were bragging that they had a $500 billion line of credit with the U.S. Treasury. Why would they need a $500,000 line of credit with the U.S. Treasury if they're an insurance fund insuring your deposits at the bank? It just doesn't make any sense. Did anybody see this hit the news? Did anybody talk about this on ABC, NBC, CNN? Of course not.
Nope.
Because they don't want the public to understand what's really going on behind the scenes in our economy. As it stands, at the end of 2012, you can see that they're still not even close to even their target funding. So when people tell me, I'm going to put my money in the bank because it's safe there, is it really? It's not. It's not insured even close to what it would be if you placed your money with an insurance company. So, moving on. As we look at the deposit insurance fund itself, I wanted to give a visual of just how dire our situation is. Because on the one side, yeah, I know you have to go through a couple of those slides because of how the graphic.
Because I didn't keep up with you.
Yeah, that's okay. It's no big deal.
Is that where we are now?
Yeah, that's where we are now.
Okay.
On the one side, if you click through, and this is going to be another one where it takes several clicks to get through. On the one side, you have that big, dark burgundy. That's the actual total deposits of $9.47 trillion. Then if you click through, you'll see that on the left side, that's our insured deposits of $7.4 trillion. That little sliver in the middle of that golden yellow, that's the insurance fund.
Oh, boy.
That makes me feel all warm and fuzzy inside. Yeah.
Hey, listen, the truth hurts sometimes, doesn't it?
Yep. The next one, again, is going to be the big burgundy, is going to be our money on deposit, $9.47 trillion on deposit. The green slice of the pie is our reserves. sliver is the vault cash. What happens if we have a bank run? Think about that. This next graphic, I got to give all credit to Otto, the gentleman that runs demonocracy.info. Anybody that has not been to his site needs to go to his site. His graphics are phenomenal. I'm a visual guy. I like to see facts and figures, but I like to see them in a way that I can make sense of visually. And every one of his graphics, whether it's talking about the FDIC, which he created specifically for me, and thank you, Otto, for that. But he also has things like what's happening with the U.S. debt, what really happened behind the scenes with Cyprus. He has graphic upon graphic upon graphic that really puts all this into perspective so that you can see it tangibly. But on this one, we're going to go through several pages here, but on this one, you'll see a $100 bill, and then you'll see a stack of $100 bills that equals $10,000. Then you'll see a stack of $10,000 bills to equal $1 million. Then you'll see the pallet of money standing next to the gentleman that equals $100 million.
Should I be back on that?
A number of pallets together that equal $1 billion. So you go from $100 to $10,000 to $1 million to $100 million to $1 billion. So you have a progression there. So you can start to put your arms around how much money are we talking about here. And it gets much bigger. Because on the next screen, what you're going to see is a skyscraper. That's the actual FDIC building in San Francisco, standing next to the Statue of Liberty. Now that pile of money right in front of it, that is how much money is in the FDIC fund as of the end of 2012. And I apologize. There's actually $33 billion. He used the $25 billion figure because that was the number that I gave him originally, which was from the end of the third quarter in 2012. So he hasn't updated this for the 2012 end of year figures, but still, the numbers still speak true.
Let me ask you a question. I'm sorry. Let me ask you a quick question. I'm sorry. I remember last year we used to follow cash on hand, especially before Christmas. There was a lot of controversy about a year ago about how much money was on hand at any given time to roll into the banks. The most important thing to know is, and I want to ask you a question about this, is I was under the understanding that right before Christmas is the biggest time, the largest funds that are available at any one given time. That there was like $2.2 trillion was ready to dump into all the banks in the country at one time if needed. And they load that fund up around Christmas time because more people need cash on hand and things like that in the bank. Now, is that mostly electronic cash that they're talking? That's all electronic. Okay. See, that's what I want to clear up because some people are going to go, wait a minute, I thought that fund was much larger than that. But I knew it was electronic, but that's why I said that. But the cash on hand is very nominal to that. Right. And that's what you're talking about here, right?
Yeah, and this doesn't take into consideration the actual money in circulation, the money under the mattress or the money in people's wallets. This is all stuff that they can track internally at banks. And that's where you get into the M0, the M1, the M2, the M3. And then our government doesn't even track the M3 anymore, but we can put the dots together to figure out what the M3 number is. But anyway, going back to that, if you look at, let me take a step back. Our M0 money supply right now has tripled actually more than tripled since 2008. We had just over $800 billion in 2008. We have over $3 trillion now. So, I mean, seriously, we're out of control with how much money we're printing. That's why the IMF is so really concerned about what's going to happen when we start unwinding this policy. But again, back to this graphic. If you look at the bottom there, that pile of money represents all the money in the deposit insurance fund. That gives you a perspective. That's a lot of money. I mean, if you were standing next to those piles of $100 bills, you'd be thinking, hoo, that's a lot of money.
Well, look at the semi over here.
Yeah, that has $2 billion on it.
Okay, all right. And then you look at what's sitting right in front. All right,
so that other one is $25 billion. Now go to the next slide, and it'll start to come into focus. Because those are all the skyscrapers of the big banks here in America, whether it's Citigroup or HSBC, Bank of America, Wells Fargo. Those are all real depictions, 3D models of those bank buildings.
Wow.
You see in the bottom left, or the center bottom, is the FDIC building. And in front of that, on the floor, in real small, is the $25 billion.
Mm-hmm.
To the left is the money on deposit.
This here?
Yeah, those are all those stacks of $100 bills.
Is it that this first tower I'm pointing at right here? No,
all
all
of
of
those
this.
stacks together.
This is on deposit?
That's the money on deposit.
Yeah, but that's, okay.
That little tiny pile in front of the FDIC building.
Yeah, that's, go ahead.
Yeah, that's the insurance fund.
Yeah, here's the insurance fund, and here's all the money on deposits.
Wait till we get to the slide with the derivatives.
Is this gonna make me sick?
Yeah, it's gonna make you cry.
I'm crying. I'm already
To the right.
Okay.
That's supposed to represent the money in circulation, but that number is way off now too. So
Okay.
but that's the one that you were talking about, probably with the 2.5
In circle, yeah.
But again, that was third quarter numbers, so that doesn't represent anything today.
What was that number? I can't see it.
1.1 or 1.3 trillion.
Yeah. It gets heavier in Christmas time. That's what they were tracking one time. And one time it got up to 2 trillion, and it was right. And people were speculating that was, and that wasn't even Christmas time. And they were speculating, and we used to watch that number a lot because people were going to have to cash out, of the dinar and see what money was on hand. And it was just funny because it was at 2.2 trillion. It wasn't even. It was I think it was the last time we were looking at it. It was either July 2011, which was one of the dates, by the way, that this revaluation currency reform was supposed to go, come around. But anyway, interesting, very, very interesting.
All right. So before you get to the next slide, I want to touch on something.
Okay.
Because in 2008. If anybody does their homework or they remember back to what caused the problem with the mortgage and the real estate, it was credit default swaps. Mortgage-backed securities that had been bundled together and packaged in a way that people thought were very solid investments, but in reality were very speculative because they were very risky mortgages at that. And what happened was people started defaulting on their loans, and other things happened behind the scenes in the derivatives market that caused that whole system to implode. So next thing you know, you have a mortgage crisis, you have a real estate crisis, and the whole stack of cards comes tumbling down. Okay? The reason I'm bringing that up is because the next slide, if you go to that one, shows how much exposure U.S. banks have today in derivatives. And this actually, again, was third quarter numbers of 2012. But all those skyscrapers in the back are the ones that were in the previous slide. Okay, and the number, you can see the stack to the left of those skyscrapers is the money on deposit. On the bottom, no, go
left.
back to the back.
Oh,
where
back
the
here.
skyscrapers are. That little stack of money there, that's the 9.47 trillion.
Gotcha.
You can't even see the FDIC backing on the floor there because it's so small.
Mm-hmm.
All those stacks of $100 bills coming at you on both sides. That's 11 football fields deep. And skyscraper high. $300 trillion in exposure that the banks hold in derivatives. Now, there's only $9.47 trillion on deposit. But they're gambling to the tune of $300 trillion. So, does it make sense if that kind of money was on the line? And it was a little bit smaller in 2008. It was like 236 or 256 trillion that was on the line. But as that derivatives market started to implode on itself, is it starting to dawn on people why we had to come up with $782 billion to give to the banks so that the banks didn't fail? I was not a fan of TARP. I think we should have let those gamblers pay and ultimately let the markets reset where they were going to reset. It would have been painful, but a lot less painful than what we're going to face here in the future. But it happened. And the reason it happened was we would have had mass pandemonium. They printed that money and gave it to the banks because of this very problem right here. There's not enough money in the world to cover the derivative exposure. That's them gambling with your money. Does that sink home? I mean, does that ring true or sink in? Does that bring it home to the perilous state of our banking system today? And that's just U.S. banks. That's not world banks.
Yeah, I'll answer for everybody else. Yes, it should bring it home.
Those are scary numbers.
Oh, yeah.
So when I look at these numbers, and then somebody in some regulatory office somewhere wants to tell me I have to put a disclaimer that whatever I'm trying to advertise is not FDIC insured, I want to laugh. Actually, I don't want to laugh. It makes me really angry. Mm-hmm. Because if people really understood this, it would make them sick. It would make them pull all their money out of the bank and put it under their mattress. So that's why I'm not a huge fan of what's going on with the banking system today. So we all know, you were just pointing to the White House there in the middle.
Yep.
That's the White House with the east and west wings. Mm-hmm. The parts that nobody ever sees because it's behind the berm, the hill, whatever you want to call it.
Right.
But that little building there is supposed to, be the head of the giant monster that backs our banking industry. It's backed by the full faith and credit of the United States of America. Sure. Okay, so let's look at the full faith and credit of the United States of America. If it wasn't for hocus pocus, phony baloney, money, magician tactics, I can't even speak to the fact of how bogus our system is, because in line with the sequestration that's happened and what they call extraordinary measures, that's their words, not mine. The U.S. Treasury miraculously for the last 2 months has frozen our debt ceiling to just $25 billion below where it's supposed to be, so that we don't go above the debt ceiling before we have the talk. That's weird, because we keep spending and borrowing money every single month, but it's not showing up on the radar. It's frozen, yet we're still spending money. So how do they do that? It's all fictitious. Really, we're somewhere close to $17 trillion in admitted debt right now. That's admitted debt. That's not behind-the-scenes money that I'll get into in a minute. Our deficit is really $1 trillion and climbing. The reason that we're not seeing that $1 trillion is, again, phony baloney, hand behind the back kind of money dealing. The sequester has helped that a little bit, but there's things going on behind the scenes that their extraordinary measures are hiding. So just understand that deficit is increasing every single day. We currently have $124 trillion with a T in unfunded liabilities. Now that's accounted for through Social Security at about $16 trillion, people that we've promised to pay, Medicare at $86 trillion, and Medicare Part D at $22 trillion. So we can see if we add those numbers up, $124 trillion. What the Federal Reserve is doing today is they're printing $85 billion, and this is what the IMF is really worried about. We're printing $85 billion every month to buy U.S. Treasuries. The U.S. Treasury, in turn, is doing its own monkey business behind the scenes to zero out what's happening as far as our debt. But the Federal Reserve is printing $85 billion every single month out of thin air to buy Treasuries. Basically, what it's doing is making loans of money that doesn't exist, because every time somebody buys a U.S. Treasury, they're making a loan to the U.S. government. If China buys a U.S. Treasury, that's legitimate, because we're getting something tangible in exchange for that. They're giving us a Chinese yuan, or they're giving us gold. They're giving us something. When the Federal Reserve does it, they're printing it out of thin air. They're counterfeiting money and buying it and expanding that money supply. That's how we've gone from $800 billion and change to over $3 trillion in just 5 years. It's all smoke and mirrors.
But yet, let me interrupt real quick. I'm sorry.
Sure.
I've got to get this question answered. So when they say now that the Federal Reserve is the largest creditor that the U.S. government has, is that fictitious? I mean, people. There's a misunderstanding. People think China owns us. I hear this all the time. I said they don't own us. They are a creditor, and they have 1.7 trillion is what it is out of the 17 trillion. there's big oil companies that buy these, because you were talking about risk, and government bonds are up at the top of the less riskier deals. So that's where a lot of these companies that make $30 billion a month have to put their money, because it's less, But I have heard, and the statistics show now, that the biggest creditor used to be American corporations, right? American investors, right? And corporations. Well, here recently, it's become the Federal Reserve. Now, is that just fictitious?
No, that's right.
Is it? So they haven't really put the money. They haven't really put their own money into this thing, because the Federal Reserve is they're an independent. They're an independent country. Independent institution, like they're supposed to be, not owned by the government. So, but they have the ability to print the currency at will, right? So, wow. Right. Okay, I just had
back before the central bank, our Federal Reserve, which is the central bank, was created. Congress used to coin our money. They would print whatever money we needed that would be backed by gold. And they didn't charge the United States public anything for it. Every dime that the Federal Reserve prints, they charge us interest on. So not only are they printing money and buying debt, they're buying that debt at interest, but the currency that they're buying that debt, they're charging us interest on. They're digging a deeper and deeper hole with every dollar that they create.
Wow.
It's a scam.
So
it's, again, nothing more than a shell game. So let's talk about the future of the U.S. dollar. You just talked about how China is one of our largest creditors. Okay? It's absolutely true. For years now, the IMF has been saying that we're getting too big for our britches. We need to be taken down a peg. And they put it in different terminology, but what they've basically said is they're looking at the world and they're saying there's an imbalance in the world. We need to have better balance. You see that with, as Stryker posts some of the conversations that we've had back and forth with emails, you'll see that they're talking about the rebalancing of quotas, how much money each country has to pay in, because the IMF basically charges each country a certain percentage so that they can be a player and have a certain say-so in the IMF rulemaking. What they're doing is they're changing those quotas, and their most recent change really impacted the BRICS, which is Brazil, Russia, India, China, and South Africa. Those were taken up, and the United States and the Euro and some of the other big players today were taken down. What the IMF wants to replace us with is the SDR, the special drawing rights. And the SDR is valued with a basket of the European euro, the British sterling, the Japanese yen, and the US dollar. And every single day those are revalued. But if you look at those revaluations, the other three fluctuate, but the US dollar is always a constant 66 cents. So every SDR, special drawing right, buys 66 cents of US dollars. Okay? So we know that they still view the US dollar as a stable world reserve currency. Unfortunately, with everything that's gone on in our economy, we're no longer deserving of that title. And the BRICS, again, Brazil, Russia, India, China, South Africa, have been crying for a way to take us out. They've been doing their own unilateral agreements, country to country, individually, so that they can make trade in their own currency. We just saw that with Iraq and India. They made their own agreement. LAS, the League of Arab States, they are now making agreements with some of these countries so that they can trade oil without using the petrodollar. They want to dethrone the U.S. dollar. You see Iran recently, actually 2 years ago and into last year, set up their own way of being able to trade their petroleum products outside of the U.S. dollar. They set up their own exchange, basically, options market, so to speak, so that they could do that independently of other world regulators. So you can see every facet of the U.S. dollar is unraveling right before us. And the IMF, since August 23rd to what day was it? The 12th. with the most recent press release, has come out very specifically and in a tampered way tried to get people to understand that if the U.S. doesn't act properly, if they do it too fast, it's going to devastate the markets. If they don't do it fast enough, it's going to devastate the markets. We have to unwind this unconventional monetary policy, the accommodation that we've given to the market, printing money. That's their way of saying we've printed too much money and we have to scale it back. The only way to scale it back is through interest rates going up and inflation going up. That's how we're going to be able to peel all these dollars back. And what they realize is that when we do it, it's going to have unintended consequences. It's going to affect the bond markets. The bond market's already going up. I think Stryker has given some information on that. If not, we can post another post on that. But Treasury yields are going up. Some have already doubled in the last 2 years. So we can see an increase in the Treasury markets. When Treasury prices or the bond rates go up, the bond prices, the value of those bonds goes down. And I'm not going to get into that, but it works like a seesaw. So we're already seeing bond values go down. The stock market is going to go down as a result of all these policies really starting to unwind. When those two happen, you're going to see interest go through the roof. And when it does, inflation is going to go through the roof. We've seen inflation. They try and hide it, but if you go to the store, the price of sugar hasn't gone up that much, but the package size sure has. You used to be able to get 5 pounds of sugar. Now it's 4 pounds of sugar. Probably didn't realize that if you're not paying attention. So, yeah, the price went up a little bit, but the packaging shrunk. So we're seeing inflation. We just don't realize we're seeing inflation. So these are the factors that are coming into play. The world wants the U.S. dollar ripped out as a world reserve currency. What happens to us when that happens? You're looking at a situation where we could realistically lose 40% of our buying power overnight, because already within the last decade, actually going back to, I don't remember the exact numbers, but certainly by going back to when Iraq has seen a dramatic change in there, the Iraqi dinar, we've lost over 40% of our U.S. dollar buying power. So what happens? Let's put it on a bigger scale. The Bank of International Settlements today, as of April of 2013, says on average every single day, about $5.3 trillion in U.S. dollar equivalents changes hands. $5.3 trillion of trade every single day. And the U.S. dollar is on 87% of those on average. So you're looking at like $4.7 trillion in daily trade. This country buying from that country, and because the U.S. dollar is a world reserve currency, they have to exchange it to dollars before they can exchange it to the other currency. Or oil trading hands, whatever the case might be. What happens if we are taken out of that $4.7 trillion market? What happens to the value of our dollar? What happens to the purchasing power? And that's why I got into the real true safe havens, if that happens, last time we met on this matter. We already realized that your money's not safe in the bank if everything starts to come unhinged. We know that your money's not truly protected in the stock market because they're not protecting you, the investor. They're protecting the brokerages that go out of business. Insurance companies are even going to be adversely affected. If interest rates go through the roof, they won't be impacted by all of their bond portfolio holdings because you don't really get the impact unless you sell those bonds. But because of the way the industry works and them having to have dollar-for-dollar backing, they're going to be in trouble when those bond portfolios go down in value. So everybody is going to be impacted on a global scale. So where is the true safe place for you to have your money? Well, part of it is going to be in things that are not denominated in U.S. dollars. Outside investments. Wait, oh, that's right, the Iraqi dinar. That kind of makes sense because that's not going to be denominated in U.S. dollars. It will get off of the U.S. dollar. It'll be revalued. And instead of having to peg against the U.S. dollar, it'll be in a free float against the world of currencies out there. As we get trade relationships built inside and outside of Iraq, as we get all those things built and the Iraqi dinar has a chance to really flourish, that's where you're going to see the value just go through the roof. True safe havens. Where are they? You first of all have to have diversification. You can't have all your eggs in one basket. But hard assets are going to be where you're going to be able to see a good store for your money. Precious metals, gold, silver are going to be the two that come to my mind. People want to talk about copper and palladium and all the others, and they have their place because copper definitely, because it's an industrial metal. I mean, you can't build a car or you can't build a computer or a house without copper. It has its industrial purpose. But silver and gold are important because they have industrial and monetary appeal. They've been used since biblical times, way back, over $2,500 years as a currency. We'll go back to that eventually, I think, because that'll be part of the basket of world currencies as a base when everything is redone. But outside of that, real estate. Because if you have a tangible asset, it doesn't matter what the currency value is in the country you live in. If you own a physical piece of property and it was worth $10,000 when $10,000 was worth $10,000, if $10,000 is now worth $1 million, your real estate is still worth $1 million because you still own that physical property. So that's why I say real estate and precious metals will be good, because as that $1 million or that $10,000 becomes $1 million, the price of gold and silver will go up to match it, because it's a physical store of currency. So those are the things that I really wanted to touch on as far as what to expect, what's going to impact our decisions moving forward, what the real risks are out there, and where are the real stores of money, where are the real safe havens, where are the places you can put your money after the fact when everything starts to hit the fan. And for those people that are interested about everything that I said about the insurance, the SIPC, the NCUA, the FDIC, I created a report for my company that we distributed to the agents nationally called Banks and Insurance. So people could see in tangible ways how this impacts them. It's a short report. It's only about 6 pages long. But it talks about everything that I just talked about, and it puts teeth to these numbers. And I also have a separate report that I started to compile that shows all the failed banks and credit unions, over 500 and counting since 2008. 500 and counting that have actually failed and cost you, the taxpayer, money because the FDIC has had to step in and take care of some of those claims to the tune of $9-point-something billion in losses. Not more than that. I don't remember what the exact number is, but it's in the report. As opposed to insurance companies that have, quote, supposedly failed. Only 22 insurance companies that after everything is said and done, not only were the policyholders made whole, but it actually wound up being a net profit to the regulatory agencies that took them over. So at the end of the day, it's incredible to see the games that are played behind the scenes where they talk about safe money and they talk about their policies and they talk about the full faith and credit of the United States government. When in reality, it's all smoke and mirrors. And if people really knew what was going on behind the scenes, they would clamor to put their money in something else, anything else other than the U.S. dollar. That's one of the reasons why I look at this Iraqi dinar. Stryker and I have had this conversation back and forth. He's mentioned it. Right now, the value is absolutely, you can do the math every which way from Sunday and validate the fact that it is backed and it is on par with the U.S. dollar as it stands right now. It has immediate means of appreciation once the RV has taken place. Where it goes from there, how far it goes up, nobody knows, because we don't know all the real numbers behind the scenes. We don't know all the factors of influence. We don't know how trade is going to affect it. We don't know how the influx of capital, because we don't know how fast the money is going to come in and expand their economy. We don't know all these things. We know that it's going to impact it. It's going to be huge. We don't know how big. Whether it doubles, triples, makes it 8 times, 80 times, I don't know. And I'm not going to try and speculate on those numbers. Just know that what you're doing today by having your money in the Iraqi dinar is way better than having anything in a dollar-denominated asset. That's all I have.
That's great. That was a lot, folks, and you might want to watch this program a few times and take a few notes. Well, we may go ahead and make, after this airs, after I put it out, I'd like everybody to watch this program first. And so I think in a few days we might go ahead and publish the PowerPoint here. The reason I want to do that, I want them to get it from you first. You know what I mean? And then they can go back and look at the PowerPoint to really have those notes. Don't you agree, Dave?
Yeah, absolutely. And,
Yeah.
and you put some information up there how they can contact Mike, and I'll give you that information. I have been hesitant, not because I don't want to give it. I've just been busy doing other things, and I just need to send you an email with my contact information so they can get that information from me.
Well, let's let them view this, and I think this will be a good way to understand you, to get to know you better. I know that the 32 participants in our luncheon a few Saturdays ago came away with and I know they did, because a few of us hung out, got to know each other, went to dinner, and I got all kinds of compliments on your presentation to everybody. Mike, like you said, he went ahead and furnished to me his contact information. So I appreciate that, Dave, because I am getting some people who want to know how to get a hold of you. But let's let everybody have a chance to watch this, digest it, go back and watch it a little bit more, and then as soon as you're ready to for me to post your contact information, I'll do that. But I think, and then we'll at the same time we'll go ahead and make this PowerPoint available to you. And how can they get the? Can they read this publication here that you put out, or is that something?
We have a way of posting it online so that they can just download the PDF.
Yeah.
I can give it to you that way. I can just send you the PDF.
Okay.
Or they can send me, once they have my contact information, they can send me an email and I can email it to them.
Okay. Perfect. I'd like to see that myself. We're starting to get a little feedback, a little bit of my voice through here. No big deal. We've gone through this a little over an hour now, hasn't it?
Sorry about that. No,
it's good. It's great. No, it's a little over an hour, and it's great information. I think it's very well needed. There's other people out there like Brittling and those folks that have done these fractional banking videos and things like that, but I don't believe there's anybody that has put it in such a well-formatted, structural presentation like this, Dave. So I commend you. I appreciate you. Yay! Get a crowd. If we had a crowd, I always say I'm gonna get one of those crowd noise MP3s, and so I can make people clap, and I can control my audience.
You'd be like Rush Limbaugh.
Rush Limbaugh. Hey, let's clap. Hey, listen, thank you very much, Dave. I know you have other things to do. I appreciate the time you do. But folks, I am going to be posting probably tomorrow because I've got things to do today, but posting our latest emails back and forth to each other, which will be educational in themselves. Remember, because of Dave's position, I can speculate all day long. And my speculations may be right or wrong. It's our opinions, my opinions. He's limited to the speculations he can do, and the reason why he attaches himself to these numbers, and I applaud him for doing that, because that differentiates what we do as a team from those who continuously throw out these fictitious numbers of $10 and $25 and all this stuff, folks. I mean, unfortunately, there's those percentage of people that are going to continue to stay on that roller coaster with those folks, which is, hey, listen, we're all big people. You do what you want to do. We're more conservative, realistic, factual thinkers, and we want to pass that on to our audience. We know that this is a good investment. I believe Dave can actually say that himself. We know we're on a right adventure journey together, and I'm proud to have Mike and Dave and all our other analysts and researchers and news hounds. So I just want to give everybody a big hand. I know everybody gives me a hand sometime. It's my time to give everybody else a hand. Dave, thank you for joining us today. Any questions, folks, info@strikerblog.com. Until we get Dave's. If you see him on the forum, he's more than happy if he has time to answer some questions sometimes. But let's try to share them with everybody so everybody gets a benefit from them. And try to post questions to them on threads and things like that where, and just be patient with both of us. We have busy things going on, and we'll get back to you as quick as we can. Thank you.
And like Stryker says, because I don't have time to get on all those threads, if I don't respond, please, it's not because I don't want to, it's because I never saw the post. So throw me a private message, and then I'll respond to you that way. Or once my information is posted, send me an email. Say, hey, listen, go to this thread so you can take a look at that article and make a comment. And I'll do it.
Yeah, and when you send us an email, myself too, by the way, that goes for me too. When you send us an email or a personal message, always copy the link and put into that personal message. So all we have to do is click on it. We'll go right to that link where you posted the question, and we'll answer it right there. It benefits everybody that way. It's called communication. Folks, thank you very much for joining us today. I know you're watching this on demand. We did it this way so we could get through it on our own schedule and not have to, in case we needed to redo anything. This went flawless, and I thank you very much, Dave. And thank you, folks, for joining us. Dave, you got anything, closing statements?
Nope, but I hear it's going to revalue tonight. It's going to be in for Monday morning.
At $22, by the way.
$22.
Thank you, Dave. We're going off the air now, folks. Thank you so much for joining us, and I'll put this book back on, a little bit of music as we go off the air together. Thank you so much, and I've got to put my specs on for this, and we will see you when we see you. Good night, or good afternoon.